The future of corporate boards. Looking ahead, the future of corporate boards is being shaped by forces that demand more than incremental adjustments. CEOs are under pressure to reinvent business models as generative AI, rapid economic changes, and shifting stakeholder expectations redefine what it means to lead. The traditional board structure, built for a slower pace and less technical world, is showing its age. Most CEOs now say at least one director should be replaced, citing a lack of readiness for the demands of AI-driven transformation and the need for boards to play a more active role in strategic planning. There is little patience for boards that cannot adapt, especially as 82% of CEOs believe their competitors will disappear within a decade if they fail to evolve. Artificial intelligence is already redrawing the lines of board responsibility. More than half of CEOs are reworking decision-making processes to draw in a broader range of perspectives, not out of preference but necessity. Gen AI exposes inefficiencies and risks that escape conventional oversight, forcing directors to confront uncomfortable truths. Some companies have experimented with digital director twins, AI-powered avatars that analyze proposals and offer recommendations stripped of human bias. These experiments have produced mixed results. At Disney, the digital board member flagged risks and challenged management more forcefully than its human counterparts, prompting the company to end the trial. Regulatory agencies are also watching closely. The Canadian Securities Administrators have warned against AI washing, where companies exaggerate the capabilities of governance algorithms to impress investors. Boards are now expected to understand the AI tools they use, but many directors cannot explain how these systems reach their conclusions, as seen when Citigroup's board struggled to justify an AI-driven trading approval. Diversity remains a persistent fault line. While gender representation is improving, 73% of ASX 300 boards now meet or exceed the 30% threshold for women. Other forms of inclusion are lagging or even declining. Anglo-Celtic directors hold over 90% of board seats in Australia, and Indigenous, LGBTQ+, and disabled representation remains minimal. In the US, the share of new non-white directors has dropped sharply since 2022, with Black directors accounting for just 12% of new appointments. The business case for diversity is well established. Companies with mixed age, mixed gender, and multidisciplinary boards respond to disruption faster and more effectively. Still, old networks and narrow definitions of board-ready talent remain barriers. The 2025 Board Diversity Index calls for broader pipelines and structured mentoring, but progress is slow. Generational differences are sharpening these divides. The average director age remains above 60, even as younger executives possess stronger digital skills and a better grasp of AI's implications. Directors under 50 are 3 times more likely to use digital tools extensively, creating gaps in how boards process information and make decisions. At Disney, younger directors relied on real-time analytics to steer streaming strategy, while older members defaulted to anecdotal evidence from management. Some companies now require annual technology literacy assessments for directors, and proxy advisors like Glass Lewis increasingly recommend voting against those who cannot demonstrate digital competence. Still, most boards have yet to make tech engagement a core expectation, and many directors remain passive participants in virtual meetings. Alternative governance models are gaining attention. Hybrid boards, which blend traditional directors with labor representatives or activist-backed members, have shown resilience during crises. After Delta's near bankruptcy, adding labor voices to the board helped preserve expertise and improve decision-making. German-style co-determination, where workers hold significant board seats, counters short-term thinking and brings operational insight. Some asset managers are testing permanent activist directors who combine investor urgency with a focus on long-term stewardship. Blockchain is being piloted for tamper-proof voting records, though these changes face pushback from directors accustomed to high pay and minimal accountability. Board tenure and turnover are also under scrutiny. In Australia, most directors serve fewer than 10 years, while in the US, average tenure is nearly 9 years, enough to breed complacency. Research suggests staggered terms and mandatory rotations improve board effectiveness, but formal limits remain rare. Companies like Salesforce have reduced average tenure and introduced rotation policies, leading to earlier detection of emerging risks. In contrast, entrenched boards, such as those in Japan, may miss red flags due to overfamiliarity and resistance to change. The skills gap is becoming more pronounced as business models evolve. Traditional boards, dominated by career executives and financiers, often lack the technical expertise needed for today's challenges. Only a small fraction of S&P 500 directors have cybersecurity or AI credentials, even as threats mount. Public companies are beginning to recruit more specialists, but the pace is slow. When the semiconductor shortage hit, boards with engineering backgrounds responded effectively, while those focused on finance missed critical opportunities. Crisis response continues to separate future-ready boards from those stuck in the past. Boards that prioritize resilience, maintain strong relationships with employees, and conduct regular stress tests are better positioned to navigate shocks. Regulatory reforms and outside pressure can drive change, but without internal commitment, improvements are often superficial. The persistence of dual-class share structures, minimal director accountability, and resistance to time-tracking proposals all point to a system that is slow to adapt. Some voices are questioning whether the traditional board model remains fit for purpose. AI tools now outperform humans at certain oversight tasks, but technology alone cannot solve deeper issues of power, accountability, and engagement. The most promising reforms focus on splitting CEO and chair roles, tying director compensation to meaningful equity stakes, and opening the boardroom to broader representation, including employees and independent experts. Change is coming unevenly, and not every experiment will succeed. Some companies are blending stakeholder and shareholder models, while others are doubling down on old practices. The next economic downturn may force more dramatic shifts, especially if boards fail to address the growing gap between what governance could be and what it is. As these pressures build, the real test will be whether boards can move beyond networking and rubber stamping to deliver the oversight and leadership that companies and their stakeholders actually need. As we look at the state of corporate governance in 2025, the gap between what boards are supposed to do and what actually happens remains wide. Directors, on average, spend little time on real oversight, yet compensation continues to rise. Insider networks still play a dominant role in appointments, with CEOs often surrounding themselves with loyalists rather than truly independent voices. Even as public companies face more scrutiny than private firms, both frequently fall short on fundamental governance standards. The push for diversity and inclusion has made some progress, but meaningful change is slow and uneven. Many boards still devote more energy to their own pay than to company strategy, and most major decisions pass with little resistance. These patterns are not isolated cases, they reflect ongoing systemic issues. For anyone invested in these companies, it's worth asking who sits in the boardroom and what qualifies